Wall Street is bracing for another risky strategy coming out of Washington, and this time, it's not just another rate decision or a spending bill. No, this time it's the US Treasury itself trying to get creative with the debt markets by launching a new wave of buybacks, funded by short-term borrowing. But this isn't just accounting gymnastics, it's a bold and potentially dangerous strategy that could reshape the US Treasury market, maybe in ways that they're not expecting. And Trump's recent very public feud with Fed Chair Jerome Powell adds a political edge to the buyback program, with Trump essentially trying to lower interest rates by other means.
I'm the motherfucker one who calls the shots.
So what I want to do today is go over the Treasury's planned buyback program, take a look at some of the risks involved in this new strategy, and then go over some implications. As we'll see today, it's uncertain times right now in the US debt market, but we will obviously continue to track how this all plays out on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into these buybacks. Onto the buybacks. The Treasury buyback program was first started under then President Biden in 2024, with the stated goal being to provide liquidity and resiliency to the then $27.5 trillion Treasury market. Trump is planning on doubling down on this move, increasing the quarterly buybacks from $30 billion up to $45 to $50, hoping to buy back nearly $100 billion worth of longer-term US debt per year. So what they're planning on doing is buying back long-term debt, those 10, 20, 30-year bonds, and financing it by borrowing short-term debt. It's almost like taking out a line of credit to pay off your mortgage.
That just wouldn't make any sense.
Well, that's true. For most people, that wouldn't make any sense. But governments work different. And to understand why the Treasury is doing this, it's worth briefly recalling that a bond's price and its yield are inverted. So, say I loan Jen $100 and she's going to pay me back $110 at the end of the term, I'm going to be yielding 10%. But let's say I need the money and I don't want to wait until the end of the term, so I decide to sell my bond that I got from Jen to Frank, who pays me $95. Frank is now going to get that $110 at maturity, having only paid $95. Frank is now yielding 14.6%. And that's essentially what the Treasury Department is trying to do under this program. It wants to borrow short-term debt and then use that debt to buy up long-term bonds, adding more demand to the long-term bond market, increasing the price of those bonds, which should work, hopefully, to bring down yields. So the United States goes to the short-term bond market and issues a short-term bill, say for a year or so. It then takes the money it borrowed from that T-bill and pays off one of its 10-year bonds that is at a higher interest rate. The US is now borrowing at the short term to pay off longer-term debt, adding more demand for longer-term bonds, bidding up their prices, which should push down their yields. And by bringing down long-term yields, the hope is that that will work to lower the interest rates on car loans, mortgages, etc., juicing the economy without the help of the Federal Reserve. Given that the United States has been seeing persistently higher borrowing costs, persistently higher yields on the 10-year bonds, despite the Federal Reserve cutting interest rates by 100 basis points since September, the hope is that lowering those long-term yields will help to boost the economy. If Trump can't get the interest rate cuts that he wants from the Federal Reserve, this kind of acts like an end run around the process. Borrowing short-term debt, which is, as of right now, less expensive, in the hopes of reducing long-term interest rates. And if this sounds familiar, it should. The FOMC voted to do this back in 2011, under what was called Operation Twist. According to the San Francisco Fed, the operation was successful to one degree or another, ultimately helping to lower yields by about 15 basis points on longer-term bonds. But that was the central bank doing it in 2011. This is coming from the fiscal authorities. This is coming from the US Treasury Department, which carries with it a whole host of additional risks. First and foremost, this puts the US at major refinance risk when these bills come due. As a 2012 GAO study put it, if these shorter-term bills come due when interest rates are higher than they are now, say due to an inflationary shock, the US could be on the hook for a lot more money. So the US borrows all this money over 1 year. If interest rates are higher, say in a year from now, well, it's going to cost the US a lot more to service its debt. Second, this sends a bad signal to the market. It tells the market that the sovereign cannot effectively manage its debt in traditional ways. This kind of financial engineering, this kind of an end run around the Federal Reserve, tells the market that the US is not effectively managing its debt. If you were a bank and you saw your client doing this, using their line of credit to pay off their mortgage, you definitely have a few questions. And finally, there is a concern that this won't even work as intended, that these buybacks could fall well short of their goals. Anshul Prada of Barclays says that the uptick in the purchase of longer-term bonds, say 10 billion or so every quarter, could be tantamount to a drop in the bucket, especially relative to the 5 trillion in outstanding Treasury bonds. What the government should be really doing, says Prada, is issuing less 30-year debt, meaning rather than issuing more new debt, the US should be focusing on issuing more short-term debt to fund its deficits, which, as we've discussed before on this channel and was outlined last year by Nouriel Roubini vis-a-vis the active Treasury issuance, A, the United States is already doing that, and B, the active Treasury issuance already comes with enhanced refinance risk as well. On the other hand, British Karuna suggested an even more bold strategy, noting without being accompanied by reduced government spending plans, the effectiveness of programs designed to influence demand for government debt remains an open question. So what Karuna is saying is that so long as the United States is borrowing 6% of its GDP every year, emergency level borrowing during peacetime, fiddling with the maturity dates with the massive refinance risk that comes along with it may not have any real impact. So we've got the United States set to bring a lot more short-term debt to the market, and the markets are bracing for impact, with refinancing, reputation, and execution risks abounding. As to exactly how markets are going to react to this flood of new debt amid already problematic debt auctions that we've seen over the past few months, not only in the United States, but also worldwide, remains to be seen. But we will obviously continue to track how all of this plays out on this channel. Make sure you click like and subscribe if you want to get those updates. But for now, thanks so much for watching.